So for today, I'd want to discuss a few alternative strategies to invest $100. So in the realm of investment, it's all about risk against return. To expand your money over time, you'll need to take a sensible risk, and it will be a roller coaster ride of highs and lows. However, the overall trend has been upward, so much of it is putting your money in and letting it ride the roller coaster. So before you start investing your money, I believe it's critical to handle any high interest debt you may have. You'll want to pay it off first, and you'll want emergency funds. I believe there are various ways to study and improve your financial portfolio. So let's get started on some ideas. Number 1. High-yield savings account. So high-yield savings accounts are simply an alternative to the bank account in which your money is already resting, where you may earn a modest amount of interest on the money that you save. It often pays more than the national average for a traditional savings account. As a result, a high-interest savings account may be an excellent choice for marginally raising your income. Because of the greater interest rate, money in these accounts grows more quickly. It will be low risk and low return, and while it not accomplish much, it will be better than letting your money sit and do nothing. Number 2. Index fund. So, let's assume you want to acquire Tesla shares. So you purchase one Tesla stock, which is like one rose, and you keep onto that rose, hoping the leaves don't fall or wither, and you hope it grows and thrives. However, placing all of your eggs in one basket might be dangerous. So an index fund is excellent because it's essentially a bouquet of various stocks or bonds. So instead of just one rose, you get hundreds if not thousands of roses. So an index fund is simply a stock or bond portfolio that mimics a certain market index. Investing in an index fund is equivalent to purchasing an entire bouquet. So if specific stocks begin to fall or certain flowers begin to wither, simply continue with my example. You've got a ton of flowers to balance things out. It's ideal for a passive investor because it's completely hands-off. Consider a fantastic starter investment since it's relatively low risk due to the stock balance throughout the board. Investing in index funds does not require any prior understanding of the stock market, and it provides a lot of diversity, so the risk factors start to drop again because you're diversifying where you're putting your money through this index fund. Of course, I'm not pushing you to invest in any specific. It's all about education, and I strongly encourage you to conduct your study on index fund in various sorts of accounts. But I'll focus on a couple of most well-known, such as the S&P 500. As a result, the S&P 500 index fund effectively replicates the performance of the 500 biggest firms or the Dow Jones Industrial Average. So if you want to invest in the S&P 500, you don't have to buy individual equities. You may now invest in all of the stocks in this index fund using mutual funds or exchange-traded funds. So if you want to invest in something like the S&P 500, you'll need to create a brokerage account. This sort of index may be found on a variety of large platforms such as Fidelity, Charles Schwab, Lynch, and so on. For example, if you go via Vanguard, there are a couple of possibilities such as VU and VIX. One is mutual fund, while the other is an exchange-traded fund or ETF. The main difference is that the VIX one has a significantly higher minimum investment, which is around $3,000. If you only have $100, this is not the way to go. However, if you want to check into alternative index fund, there are many different types of cheap index funds to learn more about. The idea of an index fund is to invest your money in it and then let it sit and grow over time for years, if not decades. Then watching it rise steadily over time as it effectively rides the stock market's wave. You should not put all of your eggs in one basket. Instead, you should diversify your investment. Since we have no idea what will happen, so I'm going to mix in a Roth IRA in this index fund part. Roth IRA. So Roth IRA is simply a tax-advantaged retirement account in which you can invest. There are two types of IRAs, standard IRAs and Roth IRAs. What makes Roth IRAs so remarkable is that you pay taxes on the front end, so when you withdraw the money at the end when you're around 59 and a half, it's tax-free. What's fantastic about it is that if you're in my age range, I just turned 25, I'm likely to be in a lower tax rate now than when I'm 60 if all goes well. So taxes are deducted from your earnings and you may then access your entire profit at the end. So according to everything I've read, you should max out your Roth IRA account, which has a ceiling of around $6,000. Okay, I'm going to bring up a Roth IRA retirement calculator to demonstrate the potential of Roth IRA in terms of investing your money, compounding interest, and all of those lovely things. Let's say I want to retire at the age of 61, but let's assume I start with $1,000 in my Roth IRA. If you save $100 a month for 37 years, your investment might be worth over $290,000. That means I'd be putting in roughly $44,400 on my end. However, the growth is 84% of the total, or roughly 245,000 people, which is absurd. Let's just have some fun with this. Assume you begin donating $400 every month, very close to $100 each week instead. It says your investment might be worth $1.1 million in 37 years. As a result, the amount you invest today has a significant influence on what your future looks like. So if you want to build a retirement account for yourself again, I recommend Vanguard. I opened a Roth IRA with Vanguard, and you may select other assets that suited you. Number 3. 401k. This is another retirement account. The beauty of a 401k is that oftentimes it's offered by your employer, and they offer a certain amount that they'll match you. So what it makes it a little bit different too is that this is money that you put in pre-tax. So when you take it out at the end of your retirement, that's when you're taxed on it. A lot of times an employer will offer a 401k match, which means up to a certain percentage they'll match what you're willing to put into your 401k, which is kind of crazy. It's essentially free money. So if your employer offers a 401k match, I would say definitely if you're able to put in at least $100, if not more, towards that match percentage. It also makes sense if for some reason you're in super high tax bracket when you're younger and you think you'll be in a much lower tax bracket when you're older. However, if you have any extra money to invest, this is a terrific opportunity to put in a good use. Number 4. Stocks. So next, I do want to discuss stocks. When it comes to investing in more individual equities, the risk-reward ratio is unquestionably higher. When investing in stocks, you must exercise extreme caution, especially if you want to invest a huge sum of money. But if you're wanting to invest $100, I think it's a terrific educational step to better understand equities. I'd argue there are fewer buried entries now than ever before, so it's a fantastic opportunity to test it out and learn as you go. For example, fractional shares are now available. You may now invest in fractional shares using a site like Robinhood. So let's take a look at an example. So the current price of Tesla stock is $735. Assume you want to invest $50 in Tesla. You may now invest in acquired shares in that firm for as little as $50 or less without needing to buy a full share. You may even take that $100 now that fractional share investing is available. Now, invest in a variety of firms, $10 here, $20 there, to see what works best for you. There are also micro-investing applications, which I believe are another wonderful choice for getting to know stocks better and investing tiny sums of money. Acorn, for example, is a fantastic example of micro-investing app that for each transaction made with your credit cards, it rounds up your purchase to nearest dollar and invests the difference for you. So if you buy a 550 coffee, it will run up to $6 and invest the 50 cents. Another option is to use robo-advisors. It's something else you should look into. Portfolio management is essentially provided online, but without a real human operating it. Instead of paying financial advisors for their time and expertise, you will likely be asked to answer a series of questions about your risk tolerance and some of your goals, and the robo-advisor will use the information to help you invest. You can time the market, and I feel if you want to learn more about stocks, testing waters is a terrific approach to learn and gradually become more comfortable with this world of stock investing. So best of luck with that. Play it safe, do your research, and I trust in you. Number 5. DIY and reselling clothing. I think this is a terrific way to possibly spend $100. Putting that $100 or so into something I knew I could produce, get artistic with, and resale was a nice way to put $100 to use. Another excellent method is thrift flipping. You might go to Goodwill and spend $100 on really nasty apparel, then resell it for double, treble, or even quadruple on sites like Depop, Etsy, or Poshmark. You may thrift flip by upcycling them yourself, such as painting them, mending them in some sections, adding patches, or just putting a personal touch on them. Many times, that value can be increased. There are a lot of opportunities to invest a little money and maybe resell for a higher price. Number 6. Invest in yourself. Last but not the least, and maybe most importantly, invest in yourself. I feel like a cliche parent saying this, but the human capital you build through time is something you can never lose. So if you invest $100 in books or $100 in a course, the things that you can take time to learn can either improve your current job, help you get a different, better job, or just overall sharpen and increase your skill set to potentially use to make more money in the future. I strongly believe that any investment in yourself that can improve your emotional health, physical health, or intellectual health is always worthwhile and a good way to spend $100. Since, once again, it's something that cannot be taken away from you and will be only strengthened and increased through time. Okay, so I don't want to be this too lengthy and rambly, so I finished it up, but there were a couple of methods to invest money heading into 2021. With a new year's ahead of us, it's a good opportunity to rethink the way you approach your finances and the way you treat financial education in your own life. And that's the end of our video. Thank you for watching. This is Jules, and see you on the next one.